Hello, and welcome to TA Intel, a podcast about the business of small business support. Each episode of TA Intel offers practical insights on leadership and professional development for the people who run and deliver services in entrepreneurial support organizations. I'm your host, Christian Conroy. I have over 30 years of experience in leading organizations that enable small businesses to start, grow, survive, and thrive. I provide leadership and strategic support to economic development and educational organizations across the country. In this episode, I'm joined by Scott Rogalski, the Deputy Director of the Northern California SBDC Network, to discuss how they have increased their capital access advising skills and incorporated fintech tools into their approach to helping clients obtain financing. Capital access is typically the number one service requested of most entrepreneurial support organizations and is often a key deliverable for program funders. My hope is this show will offer ideas on how to strengthen services in this area. Here's my conversation with Scott. Hello, and welcome to TA Intel. This episode is on designing a scalable capital center for advisor success. As most people listening to this know, capital access is the number one service requested of most entrepreneurial support organizations and is typically a key deliverable for program funders. And in this podcast, we're going to discuss how the Northern California SBDC network has built capital access advising skills throughout its team and incorporated fintech tools to help advisors navigate the funding spectrum. Joining me for this conversation is Scott Rogalski. Scott is the Deputy Director of the NorCal SBDC. Scott, welcome to TA Intel.
Thank you very much, Kristen.
Yeah, I'm looking forward to this discussion because, as I noted right there in that short intro, helping clients access capital is a major function of most entrepreneurial support organizations. So maybe to help us get started, can you explain a little bit about what the NorCal Capital Access Center is and how it's different from what you had been doing previously?
Yes, thank you. Since SBA funds us and it's our number one goal that we have to do is placing capital to businesses, debt and equity. The NorCal Finance Center, or essentially is synonym with Capital Access Center, but we cover the most 36 northern counties of California, and with that we have a large territory, lots of rural areas, and lots of geography. So we created a finance center that's essentially regionally situated. Most of the advisors are remote, and they can help any client across all the centers. We have 15 centers, 36 counties. And then we have a mixture of contractors, 1099, and then we have a mixture of 5 full-time lending specialists that do a lot of business development outreach, lender engagement, and then one-on-one advising.
But what's the finance center, though? I mean, that's a team of specialists that you have, right?
Yes, the finance center is made up of all ex-bankers or ex-lenders, ex-underwriters, ex-brokers that essentially a lot of them brought their own book of business to NorCal SBDC from the banks that they were working at, businesses that they were funding at their one local bank that they worked at. But now they have access to essentially broker out those loans to any bank that they want to work with to help find financing. So the finance center is it's a team that's housed at the lead center. It's at our state network center. It's managed by myself, and we have about 10 advisors, 10 contractors, and 5 full-time lending specialists that do nothing but help businesses place capital and work with lenders to get referrals and send referrals to lenders.
Okay. Well, speaking of, the getting capital and working with lenders and things like that, credit collateral and cash flow, I think sound pretty straightforward to everybody. But, from your experience and especially in terms of taking this new approach in terms of how you've organized your capital access services in the NorCal SBDC, what do advisors most commonly misunderstand or overlook in terms of the risks that matter the most to lenders?
Yeah, so I always talk about those 3 C's because I do think those are the most important that lenders look at. The Finance Center is essentially an extension to all the centers that we have, and what we bring to the table that the centers may not have worked out with their lender community is the other risks that banks and lenders look at that you wouldn't know unless you had a relationship with that lender or bank. The challenge with banks and lenders is that they may not like startups, and they may not like certain industries like manufacturing or restaurants or gas stations, and they may not want more real estate loans for whatever reason. And maybe you don't have enough money in your bank account to get a loan with that bank, but it doesn't mean that you can't get a loan. The nuances with and the risk within the lenders is a lot of it's based on their portfolio, and they don't just share that with the everyday public. They don't share that mostly with SBDCs unless you have their relationships. So at the finance center, we understand what the banks are looking for, what the chief credit officer wants, what the CEO wants. Do they want more real estate loans? Did they lose a bunch of money on restaurants? They don't want that anymore. A lot of the risks with lenders are more internal, because all banks look at cash flow, credit, and collateral. Like, they all look at the same thing. It really hasn't changed over the last 50 years. What has changed is the appetite for the banks, and you won't know that unless you have the relationships with them around industry, or maybe percentages within the income statement of profitability or expenses, or debt service coverage ratios. Are they more strict? Are they less strict? Did COVID really mess up the balance sheet of a bank, and how that works as they move forward with doing loans or not?
And is that where this finance center team of specialists comes in? They're the ones who have the relationships with the banks, so they know those types of inside baseball types of things that are important to each bank?
Yeah, they essentially, they know what's behind the curtain for these banks. They know
Right.
what they will do, what they won't do. They essentially can submit a really low scale, one-page credit memo of the borrower, the business owner, what they're looking for credit, and present it to the bank, and kind of know. So, most time, Kristen, a lot of SBDC advisors or a lot of brokers, they take all these clients' business, loan requests, they throw it up against the wall, and they see what sticks. And most big banks only approve like 20 to 25% of all applications. And the finance center knows what banks will do, what they won't do. So our success ratio is more like 80 or 90% for placing capital when we submit loans, because we know what they want to do.
Wow,
We're not
that's a
guessing.
tremendous success rate. Holy cow! Yeah. So you said at the beginning, did you say you have 18 centers in NorCal?
We have 15 centers.
15. Sorry about that. Okay. So you've got, it's a big network, big geography, obviously, and you've got a lot of staff and contractors that you work with. What's the breakdown between what the finance centers folks will work on versus what you expect at a local center?
Yeah, so the local centers will work on pretty much basic financial needs. Maybe they'll help them with a P&L or balance sheet, maybe some projections, maybe a business plan, expansion plan of some sort. But mostly like early stage, non-complex loans, or loan request. But we do have, a couple lending specialists that are full-time on the finance center that specialize in mini micro loans under $50,000, because it takes a lot of hand-holding with those businesses. But the finance center is really just an extension to the team. So if a business owner goes to a certain center and they're working with them, they're helping them with the business plan, projections, all this good stuff, they're not sure where to place the capital, we'll come in and help them. Or if they don't really know how to pitch it to the lender, we'll come in and help them. But most SBDC generalists or startup experts advisors know how to, essentially put the package together, collect some financials, taxes, personal taxes, interim financials, projections, stuff like that. They'll help us with that. And then if they're not sure where to place the capital, or maybe they told that business owner to go to these 3 banks or lenders and they didn't work out and they ran out of resources, then we would step in and help them place it.
How does what's the interaction like between the capital center specialists and the folks in the field? Or do you have a defined process in terms of when a referral is made to the specialist? Do they work together as a team? Are there certain things that the local, advisor does and the certain things that the specialist does? I just know from personal experience, this is a topic people I think are very interested in, trying to see if this might work within their program, and they're going to have a lot of questions about these details. So I know it's kind of, it's a very detailed question, but I know that's also what people are interested in hearing about.
Yeah, it's also a sensitive question too.
Right.
And figure out
Who gets
who
credit?
deals.
Right. I mean, that's where
Yeah,
I'm
who
going. That's
gets.
going to be my next question. Yeah. How do you
Yeah, who
define
gets
credit?
credit?
Yep.
Who deals with the client? Where does the client start? Does it
Yep.
start at the center level? So most of the clients start at the center level because they find the center link, they sign up, or they're in the community, they're meeting with a director or an advisor, and they'll sign up, and then they'll start the relationship. They'll work with them. Sometimes we do joint sessions with a finance center advisor and a local center advisor to kind of learn from each other, learn about the deal, throw in ideas, stuff like that. But the finance center, we do a lot of outbound and a lot of outreach, a lot of lender events, capital summits, stuff like that. We'll also receive referrals. We have our own link, the NorCal SBDC .org/FC for Finance Center. Clients can go there and sign up, and it'll be routed to the Finance Center team, and then we'll get them directly to, because we allow for our advisors and our staff on the Finance Center team to do outbound outreach, essentially cultivate their own lead list, per se, pipeline, prospect list to get clients. And it may start with an SBDC Finance Center person, and then we will refer it back to the center if they need help with like marketing or HR or all the other services that we provide at the center level. But we do work collaboratively. Based on your question around who gets the credit, sometimes we do struggle with that. Sometimes the centers think of us as competition, which is unfortunate. We have to break down those barriers and those obstacles kind of like case by case, center by center. We try to do a whole region rollout to calm their fears and stuff like that we're not competing with them or stealing clients. But it's much better on a case by case situation. It just takes a little bit more time, obviously. But as far as the credit goes, we share credit. We count the credit double internally. We only report one credit counting to SBA and our funders, but the Finance Center can count the $2 million loan, and the Sacramento Center can also count the $2 million loan. What we do is we only have like one primary advisor, which I know most SBDCs do that. So the primary advisor might be the Finance Center advisor, but the client is always domiciled at the center level. So the Finance Center is a fictitious center that we created in our Neosera, but the client is always domiciled where their business is geographically located for that certain center that covers that county. It's never housed at the Finance Center. It's just advised and worked with the Finance Center. So we share credit.
Okay. All right. And then are there guidelines maybe for when a client comes into a center should get referred to the Finance Center? Like, is it like if you're looking for $250,000 or more, for instance, or how does an advisor know when to bring in the Finance Center?
Yeah, so we don't have a guideline or a process for that. We used to.
Okay.
A couple years ago, we were saying that anybody that was coming in through intake, 250 or more would go to the Finance Center, but it just ended up being too many that we were taking on, so we didn't want to take from the centers. We often we meet with our directors, our center directors at a leadership level monthly on monthly director calls for our region, and we'll talk about the Finance Center and then our other regional programs that we have on how they can work with us. And we also often go to center director advisor center advisor meetings, quarterly meetings that they have, and we'll present and let them know. It is case by case. It's a little bit broad in scope of when they can reach out to the Finance Center. They can reach out anytime, but essentially it comes from the advisor. If they're stuck or they hit a roadblock or maybe the lender's asking for something that the center advisor doesn't understand what they're asking for, or how to craft the financials, or how to talk to the CPA or whatever, or pitch it, then the finance center will get involved. But it has to come from the existing advisor.
Is there an incentive for the advisor to work with the finance center?
The incentive, there's no the incentive would have to come at the end when the deal closes or the loan funds. If that advisor wasn't going to be able to push it through to the final underwriting and approval, then the incentive would be that they would be able to count this as a loan, a capital infusion loan metric and volume when they were stuck, and they weren't able to figure it out by themselves.
Yeah, I guess that's what I was getting at, because I've seen in some other programs where they have a model where you've got maybe a team of specialists that serve, a region that also has distinctive centers. Sometimes the centers will rely on that team to help meet deliverable and performance expectations that they have for their individual center, because then it doesn't cost them their resources to accomplish what they're supposed to be doing. They're just going to say, oh, well, I'll just have the capital center do all our capital.
So that does happen sometimes. Not as much as you would think.
Okay,
we oftentimes pitch that all the time and say, hey, spend our money so you don't have to spend your money, and you can allocate it somewhere else. But sometimes, when we do that, then they have extra money and they're not sure how to spend it. So then they kind of take it back. But, a center director role is challenging as they, run their budgets and allocate their resources. But we do promote that and say, hey, let the lead center pay for that. We could pay for all this outreach and all this client interaction. And then you can pay for, what makes sense for your center. And then we just share the credit.
So coming back to, I know I'm focusing a lot on the dynamic between the specialists and the field, but I just know that this is an area that a lot of people struggle with, and they're probably, curious to hear what your experience has been. One of the things I know has come up, you talked at the beginning about how the importance of relationships to know, what's truly important to different lenders. It's not just going to be the three main C's. They've got other things. You gave examples. Some will or won't fund restaurants, or will or won't fund startups, or whatever it might be. When like in the case of the NorCal SBDC, you've got these 15 centers, and they've got responsibility for a region. Is there tension between the director in terms of forming those relationships with their local bankers versus the finance center? Because obviously for the finance center to be successful, you need to have those relationships. But I guess what I'm asking, do they feel like you're stepping on their toes by coming in to a region when, they feel that they should be having those relationships?
Yeah, they do.
Okay. So
And
how do you address that?
So what we did this year was we asked all the center directors, what lenders do you want us to go visit, and what lenders would you rather us not visit? Okay. And we just took it, from their perspective. And then we said, hey, the ones that you don't want us to go visit because it's your relationship, are you okay with you setting the appointment so we can go with you and we can talk about it all together? Because we say different things. We shouldn't, but we know that the inconsistency across SBDCs for all states and countries is that you get different. There's 1,000 SBD centers, and you can go to all of them, and they'll approach capital and talk about capital like all differently. So with that, we ask them, will you make an appointment so we can go with you and we can, share our vision? And sometimes they take us up on that, and sometimes they don't. They say, hey, I don't want you to go talk to them. So lately we've been taking their lead on that. But oftentimes, Christian, it happens more than you would, maybe you would imagine it, since you come from SBDC, is that we'll go to a lender that the center has a great relationship with, so they say, and we'll share something, and they'll go, oh my gosh, I didn't know you did that. You do that? No way. Wow, we should send you leads. I said, yeah, you should.
Right. You have access to this tool, and you can do this type of market research, and right. Yeah.
Yeah, exactly. All those things. I'm all, oh, if you're going to send me a lead for research, that's at least it's a foot in the door. You're going to send me a lead, regardless if you think I can get them capital or not. Like I can, we'll work it out. Like a lead is a lead is a lead. SBDC struggle with brand new clients just randomly signing up. So referrals from banks, I think, are the best.
Yeah. Now, I'm sure what you've experienced, Scott, is totally unique to your region and has never occurred anyplace else across the country.
Never.
Uh, Goodness. Well, I mean, but you lead to, I think, another point, which is, from my experience, the way you build those relationships with the banks is when you get those leads, really kind of trying to turn those into successes. And when a bank sees that you can take a challenging case and come back to them with something that is more reasonable and is approaching fundability, that's when you really start to build a positive relationship with that financial institution.
True. Yeah, very
Yeah.
true. Yeah, those
They'll stop offloading the junk to you because
yes.
they don't want to have to say no.
Yeah, exactly.
Yeah.
But when I started this whole thing with the Finance Center and Northern Cal SBDC, I mean, it's been going on now 8 years. When we first launched it, we were in the community talking to lenders to find out what they thought of us. And most lenders said, well, we think that SBDC is where businesses go to die. And that's what they told us. And they said, well, we just don't feel comfortable giving you a lead because we don't feel that your team is competent enough to understand underwriting and financial analysis to get us what we want. And the other reason we don't send stuff to you is because your timeliness is completely off. They have to sign up, they have to go through intake, they have to do all this stuff. By that time, the deal will be dead. So I want somebody, and then the fourth thing is they don't know who to send it to. So we learned all these things. The timeliness thing is a big issue. So if you work with a client, you get a referral from a lender, they want like a 2 to 3 day turnaround. They don't want to wait 2 to 3 weeks because usually they're trying to meet their quota for the month or the quarter or whatever. So timeliness is very important for the lenders. And the centers, at times, they just don't have the sense of urgency that the lenders want. So then they just won't send the leads. And I really don't blame them.
Right. No, I mean, and those are some interesting challenges that you identified. And have you tackled all 4 of those?
We have tackled all 4 of those, yes.
Okay. Because one of the things you said at the beginning, like at the beginning, you had mentioned that your team is, comprised mostly of, former bankers. Do you have I'm assuming you're marketing that as, to get at that competency issue that you just raised, that they said, you guys don't know what you're doing. You don't understand this.
Yes, we have to, we haven't promoted it per marketing per se, but we have promoted it as we do lender outreach. So we have 15 centers, and the goal was to meet with every center director. We've done this over the last 3 or 4 years. Meet with every center director, take them out of their office, make lender visits or appointments, and introduce them to 4 or 5 lenders in one day. And we just go around their territory and meet all these lenders. And oftentimes, more than not, the director will come back to me and say, hey, Scott, I thought this was a waste of time. I didn't want to do this. But after meeting with you and the lender, there's real value in this. They really need to know all this stuff from us. And then they say, yeah, I'm comfortable with you handling the lead, or, because I don't speak that language. And most center directors don't come from banking or lending, as you know. So we have mitigate that at the finance center level. We haven't figured out how to do it at the center level because we don't really own the centers. They manage their advisors, they manage the referrals, and but what we have done is we made these lenders know that they could just come to the finance center. They can send all the referrals to me, or they can sign them up at the finance center link and we'll get them to an advisor, or they can just go directly to an advisor. Don't need to sign up. Because eventually the clients will sign up. We get it, but there's a lot of missed opportunities with SBDCs working with lenders and referrals in the first meeting of transfer of clients. Because some advisors say, oh, you need to sign up first. I can't talk to you unless you sign up. And we lose so much business that way. What is it going to hurt for me to have a half-hour conversation with you to find out your needs assessment and get this referral, this handoff, and then have you sign up 2 days later and then maybe put those notes in, 2 days later? That's okay. We can do that. Or backdate the start date of the client. You got to do what's best for the business owner and best for the bank, or they're not going to work with you, because most SBDCs don't make it easy to do business with, in my perspective. We just make it way too hard to do business with us because we have all this compliance and reporting. And I get it. That's important. At the end of the day, when we send it in quarterly to our funders. But SBA, you talk to SBA, the one here in Sacramento, I think is the best. But you talk to the director and they say, we don't care, Scott. We don't care where the business owners get funding from. Just because we're SBA, we're not promoting SBA. We just care that you get them money. It could be any type of money. And that's the way we should approach all clients. We're here to help you. We can get you money. Let's just talk about it.
Well, speaking of, we can get you money. My understanding is one of the other things that you've done as part of this, in terms of building the finance center, is working with a lot more fintech types of businesses, right? So can you talk a little bit more about what that looks like? And I think one of the things that, people are interested in is, what kind of standards do you use to vet these fintech opportunities to protect clients from predatory or, lending or, unnecessarily expensive products?
Yes. It's a really great question because the SBA in Sacramento also say that we don't like MCAs and we don't like, like merchant card advance loans. We don't like predatory lenders. We don't like anything over maybe 12% annual percentage rate. And I agree with all that. The fintechs that we use are 100% small business conscious, so that they're not going to like take them out of business, unlike the merchant card advance or the predatory lenders. The one that we use the most is called Fundica. They're a company out of Canada. But what they do is they partner with us about 5 years ago. And essentially, you can go to norcalsbdc.org/Fundica, and any business in the state really can go in there and type in their zip code, their industries, stuff like that, their business makeup, startup, stuff like that. And they can find any public, private, city, county grant, state, federal, public funding that's available to them based on their industries or their makeup, like who owns the company, stuff like that, minorities, stuff like that, exporting, whatever. And their platform it's not a broker lender platform, which I don't agree with broker lender platforms. It's a platform that doesn't give any loans out. There's no lending companies. It's all like California State has this climate tech thing. Do you know about it? Arkansas has this like tax credit. Do you know about it? Nevada has this. Do you know about it? And most business owners don't know their cities and counties have these little grants or these little loans at 0%. And essentially, Fundica has these AI bots that float around, and they'll tell you when the grants start, when they end, when they are closing soon, when they're starting soon, and how to get them. Like there's SBIR on there, there's all this good stuff. And there's another tech platform that we use called, you can go to like CRF, I think USA, something like that. And you can shop CDFIs all across the US based on your zip code. So CDFIs are usually safe. Like a grant platform like Fundica is safe because they're not brokering or offering 30% loans. And then outside of that, I don't really use a lot of other fintech platforms per se. But lender matching platforms without running your credit, like CRF USA, CA Loan Match in California, we have one. There's another company called M Street X. They're helping match SSBCI lending, which most business owners have no idea what SSBCI is or how it comes from the state treasurer's offices, stuff like that. That just helps businesses say, what's the best lender for me? What's the best rate for me? And most of those platforms have responsible lenders on there, or like, the borrower's bill of rights or something like that. All this stuff that's come out over the last 5 years. But we don't promote anything that's over 12%. We don't promote per se.
Okay. All right. If I saw something, I thought I saw a reference to something you talked about, a capital committee. Is that correct? What is that?
Are you talking about the national committee, or is there
as part of this project? Do you have a governance committee of some sort?
No, we don't have a governance committee,
Oh,
but we have um, we have thought about creating that. We just need a little bit more unity with our centers to create something like that, like a capital committee, essentially where the advisors can bring us any deal in their pipeline and have us look at it and help us place the capital or answer the questions or mitigate risks, stuff like that. If I were to create a capital committee, that's what I would do. But we have, one of the things that we do have is we do have a diversified, toolbox of like 10 or 15 lenders, um, most of which are either regionally or statewide or national. There are some local lenders, but we found that local lenders are not as flexible as regional or statewide lenders. They're either not as aggressive or they change their underwriting guidelines way too many times, and they have a identity crisis. They can't figure out who they want to lend to and who they don't want to lend to. But we have a lot of SBA lenders on there. We done a lot of research and found out there's really only like 10 different types of loans out there. There's thousands of lenders, obviously, but there's only like 10 different loans a business owner could really get. If you're looking at like a term loan or a line of credit or, accounts receivable financing or equity or debt or SBA nonprofit, there's really only like 10. So you don't need a matrix. A lot of people ask me, Scott, since you have hundreds of lenders that you refer to, I said, no, why would I want hundreds of lenders to refer to? It's just way too many underwriting guidelines to look at. It's way too many. And I just need like 10 lenders, really. And I need one for every asset I could get. If it's a $50,000 loan, a startup loan, a restaurant loan, whatever, a $50 million loan, I just need, like 5 parameters that I have 10 lenders I can go to based on like stage of business, how much they want, the credibility, the cash flow, the collateral, stuff like that.
okay. Yeah, that's an interesting perspective. And so that matrix, that listing that you have, is that something that you share within your whole network, or is that something that is just used by the finance center?
No, we share with the whole network.
Okay.
We do statewide professional development
How do
conferences.
you avoid then somebody becoming associated as like a preferred lender or partner?
Yeah.
Because people are going to say, well, I'm on the SBDC list, and yet Chase isn't, but yet, Wells Fargo is. So it makes, there could be the perception that, Wells Fargo was a preferred, lending partner of the SBDC.
I'm actually, I've worked for banks, but I'm anti-bank. I don't really like referring to big banks. Like the top 10, I don't like to refer to. They're too complex and they change their underwriting guidelines all the time, based on their shareholders and stakeholders and stuff. So we actually don't really have any banks on the list unless they are statewide. And then technically anybody could use them, like SoCal, NorCal, or if they're national, anybody can use them, really. But we don't really have that. We may have like 3 banks, but they're not the top 10 banks because they're too hard. They're too hard to work with.
Okay, so these other entities that are doing these deals, they tend to be things like CDFIs and
there's CDFIs. There's like statewide SBA 7A lenders or 504 lenders that are either statewide or national, that pretty much anybody could use. And they just get the deals done better. They answer our questions a lot easier. One of the things that comes with having a great lender relationship is really understanding all their guidelines, all their requirements, all their nuances, all their and essentially working with the business owner and collecting the financials and getting their okay that you can send it to a lender and having that lender look at it and essentially pre-flight the deal, underwrite the deal before they press submit and take an application and run their credit and tell you if they'll do the deal or not.
Right.
That's the best lender relationships that we have.
Yeah, no, it's obvious why that'll clearly lead to success for everybody. And I think that's working in the best interest of the client too, right? Because you know where their deal is most likely to be done, where, who's a good fit for the particular project that they have.
Yes. Yes.
I like that. So thinking about that, how do you measure success? I mean, obviously, it's the number of dollars, but beyond that, what are success metrics for the finance center? Is it, your number of referrals, client readiness, approval rates? I mean, what else do you look at?
Yeah. So we do look at number of referrals from the banks. And we also look at number of referrals that we're giving back. I mean, that we're finding lenders and stuff like that. Um, we look at lender engagement activities. How often are we working with our lenders? How many meetings are we having with them? How often are we emailing them? How often are we engaging with them? We have had lenders pay for monthly spotlights, something we started new in January, where they pay $3 to $5 grand and they come talk to our team, our capital team, for like an hour and share all their underwriting guidelines and stuff like that. And we've had a really good lender engagement. So part of it's lender engagement, part of it's referrals. And then the approval rates, we don't really pay too much attention to that because it's really, really out of our hands. But the number of lender engagements and lender referrals we track, and then the pipeline, how many clients are we working with and how are we talking to them?
Okay. So to wrap up, if a leader listening to this wants to begin building this type of capacity, where should they start? What would you recommend? What are one or two, practical first steps that folks could take?
Yeah, I would say working with their SBA district office and asking the SBA, either lending relations person or the director, whoever is really connected with the lenders, and ask them if they know of anybody that is currently retiring or ending their career in banking and lending, so that you can, start. That's where I started with recruitment of getting capital advisors or capital experts, stuff like that. People that know banks, know lenders, can bring over books of businesses. Obviously, we're not a sales organization, so we don't pay for those books of businesses like investment companies do. But I would start there, and then I would start doing lender outreach all by themselves, as the director, whoever is trying to do this thing. I would have them go out of their office and talk to lenders and make appointments and ask them the tough questions. Do you know about SBDC? What do you know? What don't you know? Do you feel comfortable sending us leads? Do you think we're competent? Like the good, the bad, the ugly. I want to know it all. And ask those tough questions. And then from there, essentially you're building your team, and then you need to go to the lenders and get referrals if they're not coming to you, and then do lender engagements and then create a team. I know that allocating resources is an issue with SBDCs and have enough money to do all this, so you can start small with like one person or two person team. But yeah, I would say with SBA and then the lenders, and then start doing some outreach.
Okay, great. Well, I appreciate you coming on and talking about what your experience has been in terms of building up the finance center for the Northern California SBDC network. My understanding is that if people listening to this want to learn a little bit more, you're going to actually be presenting on this topic at the upcoming ASBDC annual conference. Is that correct?
That is correct. Thanks, Kristen. I am speaking at the America's SBDC conference in Atlanta.
When is that? Do you have a date and time that you want to share? Or?
Yes, it's September 29th,
Okay.
from 1:30 to 2:30.
All right.
And I'll be talking about how to design a scalable capital center. And we actually will have a representative from Fundica there as well, since they're part of our capital stack that we promote and talk with. So we're excited to have them as well.
Yeah, and it's so anybody listening to this too, if they want to follow up on some of the things that you raised and ask some questions and dig a little deeper, they'll have an opportunity to do that in person with you, right?
Yes, exactly. Yes.
Sounds good. All right, good. Well, hey, Scott, thank you very much for joining me and sharing, insights on how entrepreneurial support organizations can better, bolster their capital access services. Like I said, this is a core component of what we do. And I think, learning about new approaches to doing this is in our best interest, as programs, but more importantly, I think in the best interest of the clients that we're serving. So thank you again for your time and for participating in this.
You're welcome. Thank you, Christian. Appreciate it.
All right. Thank you for joining us. We would appreciate it if you could do 3 things. 1, subscribe to this podcast, TA Intel. 2, share this podcast with your colleagues. And 3, leave us a comment on what you would like us to cover in future episodes. We hope you will join us again in other podcasts of TA Intel. And if you run an SBDC, then you know the accreditation process is about strengthening your program's performance, such as increasing capital access. To learn about other key items of accreditation, you might want to consider participating in the Ascend Accreditation Accelerator. Here's a quick overview of it.
Welcome to the Ascend Accreditation Accelerator. This program is designed to help you streamline your accreditation process. The purpose of the Ascend program is to ensure you are fully prepared for accreditation. We will help you assemble the necessary documentation and understand the standards. Through Ascend, you will receive tools for development, management, and benchmarking. You will also get samples, interview exposure, and an assessment tool for your program's operations. The program includes 7 on-demand webinars detailing the Ascend model process. It also features 6 live peer learning sessions on Wednesdays. Ascend provides 3 key tools and essential resources to demonstrate meeting the standards. A key item is the Accreditation Documentation Tool. This helps manage the materials to include in the self-study. The program also includes a benchmarking tool with charts and data to compare your performance against peers. You will use the Ascend Key Components Assessment to review strategic thinking, planning, and program results for learning and improvement. You will learn from veteran SBDC leaders with real-world experience, who will share proven and tailored approaches to manage your program and achieve accreditation. Registration for the 2026 Ascend Accreditation Accelerator cohort is now open. Be sure to register before the deadline on August 7th. You can find more details and registration information at www.taadvisors.org/courses. For more information on the Ascend Accreditation Accelerator or any of our services, please contact Christian Conroy.
TA Intel is a production of TA Advisors, LLC. Copyright 2026, all rights reserved. For more information, visit taadvisors.org.